In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about how India's top private banks are staying strong despite slowing growth and tighter margins. And in the second story of the day, I'll talk about why gas companies are earning less money even while CNG usage keeps rising across India. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 30th of April. India's biggest private banks recently shared their results for the quarter that ended in March 2025. Now, these more specifically are the earnings of HDFC Bank, ICICI Bank, and also Axis Bank. And these results are very closely watched because these three banks together make up a very large chunk of India's entire private banking system. So basically, whatever they say or do usually gives us a great sense of where the broader economy and credit environment is heading towards. Now, the numbers this time around do not show blockbuster growth as such, just like they showed in the previous year, but they do tell us a very interesting story, which is a story of steady profits, good control over bad loans, and banks playing it safe while also preparing for what lies ahead of them. So let me start from the very top. See, all banks made profits this quarter. In fact, none of them even looked weak or troubled in any major way as such. But if we compare their profits with the same quarter last year, the pace of growth has clearly slowed down. Now, among these three banks specifically, ICICI Bank has performed the best, where its profit for the March quarter has grown by 18% compared to last year. HDFC Bank's profits has gone up as well, but only by about 6.7%. And Axis Bank, on the other hand, has shown almost no growth in profit this time around. So the basic point here is very simple. Profits are still coming in and operations look stable, but the pace of growth has sort of started to cool down. And when you dig just a little bit deeper beyond the surface, what you realize is that this slowdown is not just a one-off case. It's actually a part of a broader trend that is happening in the Indian banking space. But profit and growth are only one part of this story. The health of a bank's loan book, which basically means how many loans are actually being paid back on time, is just as equally important. And this is where something called asset quality becomes really important, because in this quarter, that particular part looked quite solid across banks. See, all three banks showed low levels of bad loans. Now, these, for your reference, are technically called non-performing assets or NPA loans, which basically are loans which have not been repaid for 90 days or for more. Now, for banks, keeping this number low is a sign of responsible lending and solid recovery mechanisms. If we take HDFC Bank, for example, its gross NPA ratio was just 1.33% by the end of the March quarter. This is still a small increase compared to the same time last year, but that is mostly because of its recent merger with HDFC Limited. And even then it is quite low, and the net NPA, which is basically the number after taking into account what the bank has already provided for, stood at just 0.43%. ICICI Bank over here did even better. Its gross NPAs came down from 1.96% to 1.67%, and its net NPA stood at about 0.39%. And Axis Bank was also in a very similar position. Its gross NPA was down to 1.28% and the net NPA dropped to 0.33%. Now, these numbers, by the way, are among the lowest in the recent few years. What this means in simple terms is that the loans given by these banks are for the most part being repaid without too many issues. And even if there is a slight uptick in stress in certain pockets, like microfinance or unsecured retail loans for that matter, that pain has not really showed up in the books of these particular big banks. Now, these types of loans usually form a very tiny portion of their total portfolio, so any trouble there does not really affect them as much. And unlike smaller banks or NBFCs who are much more exposed to such risky lending practices, these larger banks have the luxury to sort of stay away from it. In fact, they've actually been quite conservative in their practices. They are setting aside extra money, which are also called provisions, just in case some loans go bad in the future as well. Axis Bank, for instance, has made provisions that are 157% of its existing gross NPAs. Now, that, to give you a point of reference, is like having more than 1 rupee of protection for every rupee of bad loan, just in case things go south. Largely speaking, it's a very cautious and a healthy sign of a bank. So basically, if you are somebody who has a bank account or you are an investor in these banks, this part of the story could possibly give you some level of confidence. Basically, the banks are not overstretched and they've kept their house in order, and they are also ready for any sort of bumps along the road now. But that said, let's now move on and talk about where things have actually slowed down this time around, which is growth. See, compared to about a year ago, banks are not lending at the same aggressive pace that they were anymore. A year back, India's overall credit growth was around 16.5%. By March 2025, this had dropped to around 11%, and that is basically a very sharp slowdown. And this was not just because of a weak demand. In fact, in many cases, banks themselves pulled back. They basically wanted to reduce their loan to deposit ratios, which is, by the way, the amount that they have lent out in comparison to how much they have collected in deposits, because those ratios had become way too high for them. HDFC Bank is a great example here. They reported loan growth of only 7.7% this quarter compared to the same time last year. Now that is pretty low, especially for HDFC Bank, which usually grows in double digits every single time. But this, mind you, was planned. After its merger with HDFC Limited, the HDFC Bank found itself with a very high loan to deposit ratio, so therefore it deliberately slowed down lending and they focused more on collecting more deposits. And the good news here is that it definitely succeeded. Its deposits grew 16% during that time, which is far more than its loan book. So while the growth numbers on paper looked fairly soft, what was actually happening behind the scenes was that the bank was laying the groundwork for future growth by improving its funding base. Anyway, ICICI Bank, on the other hand, did not slow down as much. Its domestic loan book grew by 13.9%, which is quite strong given the overall environment that we have currently. And this growth came from both retail and corporate borrowers, with corporate lending doing especially well thanks to strong demand from small and medium businesses. ICICI Bank's deposits also grew in line, so it did not face any funding pressure as such. Now, even though the share of low-cost deposits, which is also called CASA or current account savings accounts, dipped slightly, they still managed to maintain good balance over here. And if we talk about Axis Bank, their loan growth was about at 8%. Again, it was not very high, but it was also by design. Basically, the bank's leadership said that they were more focused on keeping their margins and lending quality intact rather than chasing aggressive growth as such. So while some segments like SME lending grew by 14%, others like retail and corporate lending stayed in single-digit ranges. On the deposit side, Axis did manage to boost its CASA ratio, which, like I said, was current account savings accounts, though like others, it also saw a lot of new money flowing into term deposits where customers usually earn more interest. So broadly speaking, if I were to summarize this, credit growth is slower, yes, but deposits are growing as well, which is a good sign in some sense. Banks are basically preparing their balance sheets so that once the environment is a little bit better than what it is now, they can lend more freely without really stretching themselves too thin. And many analysts also expect that this current slowdown in credit growth is only temporarily and will improve as time progresses. Basically, as interest rates stabilize or fall and demand starts picking up again, loan growth could really bounce back in a big way. In fact, HDFC Bank's management also believes that the worst of the credit cycle is already behind us as we speak today. They expect a slight uptick in NPAs and credit costs in the short term, but they are confident that growth will return very soon. And that brings me to the next key part, which is margins. See, margins, for your quick context, are basically the difference between what a bank earns by lending money and what it pays to depositors. It's very simple. Now, this is called net interest margin, or NIM. Now, when interest rates were rising, banks were benefiting because they could charge borrowers more while they were still paying depositors relatively lesser amount of money. But now, with rate cuts on the horizon, this trend is seeing a reversal. The thing is, lending rates fall very quickly, but deposit rates don't always drop immediately. So margins in the middle actually start getting squeezed. Now, this quarter, margins were largely stable, but they showed some downward drift compared to last year. HDFC Bank's NIM stood at 3.73%, which was flat from the previous quarter, but lower than what it used to report before the merger. Now, this merger brought in a lot of home loans and also led to a rise in high-cost deposits, both of which pulled down their margins. The bank said that this level may continue for some time, especially if the RBI cuts rates even further. And if we talk about ICICI Bank, they stood out over here as well. Its NIM was about 4.41%, which was fairly steady and among the highest in this sector. Now, this was thanks to a strong CASA base and smart pricing of loans. The bank's management noted that the margins have settled in the low 4% range and they expect it to remain there for the foreseeable future. And talking about Axis Bank, their NIM came in at about 3.97%, which was slightly lower than this year, but still slightly higher than the previous quarter. So basically, it seems to be stabilizing in general. Now, with the better CASA ratio and some surplus liquidity in hand, Axis could basically see a little relief on this front. But it still has to be careful about deposit costs, just like every other bank also has to be. So basically, across the board, one challenge is definitely clear, which is that depositors are now demanding higher interest. So banks have to either pay up to retain money money or they risk losing their deposits. This makes it harder to protect margins, and if the RBI cuts rates, it might put even more pressure on banks' earnings, at least in the short term. Some analysts expect margins to remain under stress for the first half of FY 2026. But despite this, the overall profitability of these banks seem to be very strong. Their return on assets, which is basically a measure on how well they turn assets into profits, remain healthy at around 1.7 to 2%. So even though their margins are slightly thinner in comparison to the others, they are still operating in a very, very solid range. So basically looking ahead, the tone from all these three banks is of cautious optimism in some sense. No one is of course promising some explosive growth in FY 2026, but they're also not seeming too worried about what's currently happening. HDFC Bank has said that once it finishes digesting its merger, it will aim to match or even beat industry credit growth in the next year. ICICI Bank has not given exact targets, but it sounds fairly confident in continuing its balanced growth approach. And Axis Bank's CEO openly said that they chose to focus on sustainability and profit this year, but they're ready to grow faster when the time is right for them. On that note, let's move on to the second story of the day. See, if you've been looking at the recent earnings results of India's gas distribution companies, you notice something very interestingly odd. Their revenues are growing up, which usually signals growth, of course, but their profits are actually falling down, and that is a surprising and also a bit of a worrying trend. This basically tells us that something deeper is shifting in India's CNG story. Let's take Adani Total Gas as an example here. See, in the January to March 2025 quarter, its revenues rose by more than 15% compared to the same period last year. But despite that, its net profit actually fell by nearly 8%. And if you talk about Indraprastha Gas, which is by the way another major player here, they showed a very similar story, which was more revenue but less profit. And this is not just a case of these two companies, by the way. It's also a part of a broader pattern that is beginning to show up across the entire sector. The question then is, what's exactly going on, and why are companies selling more gas but are earning less money? To understand that, we need to take a step back and understand what CNG really is, why it became popular in India in the first place, and why that model is now suddenly facing trouble. See, CNG, for your context, stands for compressed natural gas. It is mostly methane that has been compressed down to less than 1% of its original volume, which makes it easier to store and transport. It's basically used as a fuel in vehicles that are specially designed to run on it, like green stickered autos, taxis, and even personal cars that you see in some big cities. Now, those all run on CNG. CNG basically became popular in India for three big reasons. The first one is it is cleaner than petrol or diesel. Now, that made it especially important in cities like Delhi, where air pollution levels are a serious problem. In fact, back in 1998, the Supreme Court stepped in and made it compulsory for all public transport vehicles in Delhi to switch over to CNG. The second reason is that it was a lot cheaper than petrol or diesel. See, at one point, drivers could save 30 to 35% on fuel costs simply by switching to CNG. And even in 2025, despite some level of price hikes, running CNG vehicles is still about 25 to 30% cheaper than running a petrol vehicle. And the third reason is that the government pushed it very hard. They didn't just follow court orders, they also actively invested in building CNG stations, and they made policies that kept their prices low. And this made it fairly easy for consumers to make a switch. Now, this is a mix of cleaner air, lower cost, and strong policy support led by a massive boom. India now has about 7.5 million vehicles that run on CNG, which is 3 times more than what we had in 2016. And the number of CNG stations has also grown quite fast, from just around 1,000 in 2016 to more than 7,400 stations today. And car makers responded to this demand as well. A few years ago, you had only a handful of CNG car models to choose from, but today there are more than 30 variants across different brands. So basically, demand, while it has grown steadily, has definitely grown, and more people are now choosing CNG. And as a result, of course, more gas stations are coming up, car manufacturers are rolling out more models, and a lot of other things are happening. So basically, on the surface, it seems like a great success story. But still, the problem is, despite all of this, gas companies are seeing their profits shrink. Why? The problem lies on the supply side. And to understand that, we need to talk about something that is called APM gas. Now, APM, for your context, stands for Administered Price Mechanism. Basically, under this system, the government supplies natural gas to companies at a fixed subsidized price. The gas mostly comes from fields operated by state-run oil and gas companies like, let's say, ONGC. And the reason this is important is because APM gas is much cheaper than buying gas from the open market. And for many years, that has been the backbone of India's India's CNG system. It has allowed companies to sell CNG at low prices while they still make enough profit to sustain their business. But this system is now starting to show some cracks. The government-owned gas fields that supply APM gas are now starting to get old. Their production is starting to fall, and as much as 9 to 10% every single year, and India has not found new big domestic gas fields to replace them right now. So the total supply of cheap APM gas is shrinking quite rapidly. And in order to manage this decline, the government has been cutting back on how much APM gas it gives to city gas distribution companies. In October 2024, the allocation was cut from 68% to 51%. Then in November, it dropped again to just 37%. There was a small increase in January 2025, but overall the supply of subsidized gas has fallen quite sharply. So basically now CNG distributors have a very big problem. They're getting less cheap gas, and in order to meet the demand, they have to buy more expensive gas from the market, either imported LNG or gas from domestic fields that is not subsidized as such. Both of these options are far more expensive. APM gas currently costs around $6.75 per MMBTU, but alternatives can cost anywhere between $10 and $14. So imagine this, if a CNG distributor has to move away from APM gas to market gas, their input cost almost doubles overnight. And that is what is hurting their profits right now. They're basically stuck in a bit of a dilemma. If they absorb the extra cost, their profit margins vanish, and if they increase their prices too much, customers may stop seeing CNG as a cheaper alternative in the first place, and they may actually shift back to petrol or diesels. Now, so far, gas companies have tried a bit of both of these things. They have tried small price hikes and they have reduced their margins, but the thing is, neither of these options are sustainable forever. Now, you might wonder, why does India not import more gas to make up for the shortfall? See, in theory, that is possible, but it's not at all easy. India does not have any gas pipelines that connect it to other countries. So to import gas, we actually have to do it via ships, and that is not a simple matter at all. Because in order to transport gas via ship, you first need to turn it into a liquid, and that means you need to cool it down at a very, very low temperature in the exporting country itself. And even when the ship arrives back in India, the gas has to then be converted back into gas form using a regasification terminal, which is usually near the coast itself. And it does not even end here. It then has to be transported from these coastal terminals to cities and towns via pipelines or by trucks. And of course, as you may imagine, this entire process is very, very expensive. And that is why imported LNG often costs 2 to 3 times more than domestic gas. And there is another problem, by the way, which is uncertainty. See, importing LNG takes time and a lot of planning, but gas policy in India is still fairly unpredictable. Basically, when domestic gas allocations are cut without a warning, there is no quick way to arrange extra LNG imports. So even though India has added LNG terminals and infrastructure, these imports cannot really fully make up for the shortfall of APM gas, not quickly and not cheaply for sure. And this particular mismatch between growing demand and tight uncertain supply is creating more pressure across the entire system. India's domestic gas production is largely stagnant because of this, and in the last decade, production has risen only by about 3%, even as demand has shot up by as much as 30%. And this means that India now only meets about half of its natural gas needs from local production. And this is why the APM gas pool is now drying up. And at the same time, infrastructure bottlenecks make the situation even worse. Even though India is building pipelines and terminals at a very fast pace, the network still has many weak links. For example, in May, a pipeline issue in Pune led to a city-wide CNG shortage. More than half the stations ran dry, and drivers had to wait in line for many hours. And as gas gets scarcer, the government has to prioritize who starts to get it. And between pipeline gas to homes, industries that use it as a raw material, and CNG for transport, CNG usually comes in the end. So when there is a shortage, vehicles feel the pinch first for sure. What we are seeing currently could be early signs of this across multiple cities. CNG stations in some areas are reporting low pressure issues, long queues, or even temporary closures because of it. Also, if you're wondering, we are not alone over here. Pakistan and Bangladesh both have had major supply issues recently. In Pakistan, for example, CNG stations were shut for many months at a stretch in some areas, and Bangladesh had to limit operating hours of CNG stations in order to conserve their gas. Now, of course, India is not there yet, but it is a clear warning of what could potentially happen if these issues are not addressed while the time is right. But that said, despite all of these challenges, the long-term outlook of CNG in India is not entirely negative. The government still wants to increase the share of natural gas in India's overall energy mix from around 6.5% now to around 15% in 2030. CNG is expected to play a very key role in that particular transition. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, India's Index of Industrial Production or IIP rose by 3% in March 2025, up from 2.72% in the month of February, which marked a mild recovery after a 6-month low. But despite this uptick, full-year industrial growth for FY 2025 stood at 4%, which is the weakest in 4 years and notably also lower than the 5.9% that was recorded in FY 2024. Second, Adani Green Energy Limited posted a 59% year-over-year rise in net profit to 2,001 crore rupees for FY 2025, which was supported by significant greenfield capacity additions of 3.3 gigawatt across Gujarat, Rajasthan and Andhra Pradesh. The company's total income grew 18% to 12,422 crore rupees, while revenues from power supply rose 23% to 9,495 crore rupees. Third and the final one for the day, Apple's plans to expand its iPhone production in India faces challenges as delays in importing crucial machinery from China could impact the launch of the iPhone 17 and the company's broader production goals. In FY 2025, Apple exported iPhones worth 1.5 lakh crore rupees from India, with about 20% of these exports heading to the US. The company's ambition is to increase production capacity to 26 to 27 billion US dollars by FY 2026, aiming to meet the 40 billion US dollars iPhone demand directly from India. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.